Many people on the internet say that you should buy term insurance instead of whole life insurance. Stay tuned to this video and I'm going to explain why I haven't listened to that advice for my whole life. Last week's video, Hold On for Dear Life, got about 2,400 views. And I don't know whether it was the word life in the title or not. So I'm coming back with a second title, My Whole Life, and we'll see if life is a magic word. I have a feeling it was the word crypto in the script that did it, but we'll see. I actually have wanted to talk about this topic for a while, but I kept putting it off like most people do when it comes to life insurance. But a question came up recently on a chat that I followed and talked about life insurance and why you should only invest in term life insurance, not whole life, because it's far cheaper and you can invest the difference. And to me, that's wrong advice, and I want to offer my advice as to why. I should begin by saying that while I worked about 20 years in corporate communications in the insurance industry, I am not a life insurance agent. I've never sold life insurance. Take this, as you do all of my videos, as entertaining ideas from one educated consumer to another, and always do your own due diligence and seek out a professional if you need one. Since I'm giving my standard warning a little earlier, let me also include a special request. Please like and subscribe to this video. The more that do, the higher it'll be in the search results in YouTube. I'm getting very close to 1,000 subscribers. Send me over the top. But I also wanted to speak from personal experience. My dad never had whole life. He never had a permanent life insurance policy. His only coverage was a group term policy at work. And he lost that just as he was approaching age 50. When he was laid off, somebody thought it'd be a great idea to save money on the pension fund if you lay off everybody approaching the vesting age. So there he was without a job, without benefits, without life insurance. And just as he was going back into the workforce, getting a next job, he had the first of 3 heart attacks. And he never worked again, and naturally he never got life insurance, could never pass the medical underwriting. So when I was in the insurance industry and started learning about life insurance, I knew I did not want to be in the circumstances my father found himself. So I started learning about life insurance, and let me tell you some basic facts. So there are a few main purposes of life insurance. It's not an investment, it's insurance. Life insurance is a contract to pay a death benefit in the event of your death. And that money can then be used for final expenses, funeral expenses, taxes. But its main purpose is to replace your income for a set number of years. Now, if you're single or newly married, the term insurance that you can get at work is probably sufficient. But once you start having children and more people depend on your income, you should really look at creating a layer of insurance that you control, not your employer. So that if you lose your job or switch jobs, you always have some life insurance to protect your risk. And again, that can also be term insurance. But there are reasons, particularly with your health and health history of your family, you might want to consider whole life, and I'll get to those. First, term insurance is generally an increasing premium. Although you can get some that are a level premium, most cases it's going to go up in cost each year as you get older. And it only lasts for the term of the contract. 10, 20, 30 years. If you die at 31 years after the term is over, you don't get any death benefit. You've paid the premium for that death insurance, but you don't get anything because it's outside of the term. Permanent or whole life generally has level premiums as well, but it's also designed so that after paying about 20 years of premiums, that life insurance contract will continue to provide a death benefit for your whole life. The other thing whole life does is it builds up a cash value so that after the, say, 20 years of premiums that you pay into the policy, that cash value can then be used to continue the policy coverage so that there's coverage no matter when you die after you've paid your premiums. Now, permanent life insurance includes simple whole life, as well as more complex universal life policies and variable life insurance policies. Variable really gets into mixing insurance and investments, and so I'll leave that off. Universal has the ability to contribute more to build up cash value inside the life insurance policy. Life insurance is insurance, not an investment. It's meant to protect against the risk of your untimely death. But a permanent life insurance policy builds up a cash value that does have value, particularly in a DIY retirement that happened sooner than it expected. I have a cash value in my policies that we can tap with a loan should we need to. Now, I have not included it in my investment portfolio. So when I talk about how I've invested stocks and bonds, life insurance and my home equity are on the side as values that I can tap if I need to. Of course, if you take a loan against that cash value, it has to be repaid. And if you have not repaid it when you die, that is subtracted from the death benefit that the policy would pay out. Now, I'm going to talk about how I got my policies from Northwestern Mutual Life. And as I told somebody on the internet recently in a chat, it was pure luck. A friend started producing for a Northwestern Mutual Life agent, and I knew the reputation of the company. I knew it was A+ rated, and I knew it was a mutual insurance company. Meant that it could pay dividends to policyholders, not stockholders. So I was interested when I heard that he was producing for a Northwestern Mutual agent, and I invited Gary over. Now, this was soon after my son was born, and I knew I needed to build up that layer of insurance that I controlled, not just my employer group term. And he started his pitch. About halfway through the pitch, I said, Gary, you can relax. Let's just fill out the applications. I know exactly how much insurance I want to purchase. Now, generally, the rule of thumb is 5 to 10 times your salary. I've seen estimates recently that it's 10 to 20 times your salary, but that's inflation for you. But back then, it was 5 times your salary. And so I went in with a mix of policies that I would own, a whole life and a term policy. And I selected 1 time salary for my whole life and 4 times my salary for a term policy with the right to convert later in its life. So I also purchased policy for Marie, and later we converted her term policy to a whole life policy. And about 10 years down the road, we converted my term policy into a larger universal life policy so that I could be sure that the children would have money for college no matter what happened to me. Now, fast forward to when I was retired in 2015. It was after I wrote my last check for tuition that I knew I did not need to replace my income anymore. My earning years were over and I was forced into retirement early. But I did not need to replace my income any longer. I was able to meet with my agent, and he was able to convert most of the policies to paid up life insurance. That means the cash value was enough to make sure the policy stayed in force for the rest of our lives. Now, in fact, the larger policy that was there to pay for tuition if needed had enough cash value that it's paying the premium for my long-term care insurance. I will never have to write a check for a long-term care premium. It's coming out of the cash value of that policy and paying for the long-term care policy. I mentioned in this video how much is enough, that life insurance agent was one of 3 trusted advisors that I used to help review my financial plans when I was retired. And I did not pay him a fee. I'm sure he's compensated by the commissions that he got while I was paying him premiums, but he didn't charge a fee and I didn't need to pay an asset under management fee. He provided his professional advice as a chartered financial consultant on whether I had enough for my retirement, and I did. So to sum up, don't just listen to the rule of thumb, always by term. Think about your underwriting, your family medical history. It may make sense to ensure that you will have that policy for your whole life by looking at a layer of permanent life insurance. It may be a wiser choice than term insurance that gets more and more expensive. If you find yourself in your 50s and you can't afford the life insurance, it's of no value to you. And if your health deteriorates, you may not be able to continue with a policy after that initial term is over. So look at term insurance for some layer, but also look at permanent insurance as part of your plan. So I view permanent insurance as a practical way of ensuring that you will have income replacement no matter what happens to your job and no matter what happens to your health later in life. Look at the right mix for you and make sure you talk to someone you trust to buy the right kind of insurance.